Stephen Cohen is, of course, the owner of the New York Mets baseball team, but here in the stock market world, we also know him for being one of the richest and most popular hedge fund managers of our lifetime, with his investment firm Point72 Asset Management currently holding close to $40 billion of assets under management. And it just so happens that in the most recently released regulatory filing, we saw that Stephen went pretty hard on 5 giant stock purchases. One of them, by the way, was a brand new addition to his portfolio where he purchased millions of new shares, while the others were increases of many thousands of percents each. It's pretty interesting stuff here. And so in today's video, you know that we got to run through these stocks here. I'm going to give you my own opinion on each one of these, and I'll even rank them from best to worst based on my opinion and at today's prices. It's a lot of fun when we do these videos. I hope you're enjoying them, but let's not waste any time here. So I want to jump straight into this list here of 5 stocks that Cohen is buying. All right, now we'll be sorting these from smallest to largest position in the portfolio, with purchase number 1 being Evergy, ticker symbol EVRG, which Cohen increased his position on by over 1,000%, bringing it up to over $188 million worth. Now, this is actually a stock here that I don't think I've ever covered before on the channel, and if you've never heard of them yourself, well, they're actually a utility that provides electric services to both residential and business customers. They've also invested a ton into renewable sources like wind and solar, which are, of course, growing trends within the massive energies market. And because this is a utility, they tend to benefit from regulated rates that help them maintain more stable and reliable earnings than perhaps other energy companies out there. With that said, though, our current macroeconomic conditions are not very favorable to Evergy, leaving them starving for growth at a time when their stock price has also seen very choppy performance. Not only has it actually gone down over the past 5 years, but it's been extremely volatile the whole, way through along the way. And part of the reason for that is because Evergy and some of its activist investors have at times even tried to sell the company to other bigger rivals. There was even a point when NextEra Energy, which is one of my favorite renewable energy companies out there, was reportedly offering Evergy many billions of dollars to acquire them. Still, Evergy ultimately declined all of the offers, deciding that they really weren't good enough for what they felt the company was actually worth, and so they maintained control ever since. Now, personally, I wouldn't say that I'm the biggest fan of this stock. However, I do understand why Steve and many other investors would want to own it, as the falling stock price has lowered their valuation to some pretty cheap levels here, where they now trade for a significant discount to the sector on a PE ratio basis, while the dividend has also risen to more than a 5% yield with over 2 decades of consecutive growth thanks to those strong utility earnings. That's pretty attractive. I also think that the stock will see better overall performance longer term, which we've also seen happen over the past decade. And so my kind of speculative guess on this is that Cohen probably sees this as like a value stock that he can also collect some dividends on over time, with there also being a potential of it getting acquired by a larger company in the future, which usually does come at a premium. So I think the risk here is somewhat limited because of that, and that's what makes this a more attractive stock than it might otherwise be. I'm kind of 50-50 on it myself, though. I think the business is not, all that exciting for me personally, but I will still give it like the middle ranking here at number 3, because I think it's a decent enough all-around kind of stock, and we'll put it there at number 3 until we see what else is on this list. Okay, moving on to purchase number 2, though, we have a stock here that I also rarely have ever talked about. I'm not sure if I've ever even covered it, but that stock is RH, formerly known as Restoration Hardware, ticker symbol RH, and Steve increased his position on it by over 700% in the quarter, bringing it up to almost $200 million worth. And yeah, most of you probably know about this company. They own all of those RH outlet stores, including also some really nice gallery stores that you may have visited at some point. But either way, they also have a growing online presence too, all of which are used to sell all kinds of different home furnishing products across many different categories like furniture, lighting, textiles, bathware, decor, outdoor and garden, and much more. Personally, though, I'm not the biggest fan of this one myself. I get that they're obviously targeted more towards rich people, but just kind of browsing through some of their, what I would say are very generic looking dining tables that I actually think are pretty ugly to begin with, in my personal opinion. Well, they still cost thousands of dollars, which I think is ridiculous. And it's kind of hard for me to get behind a company like this when I don't even really like their products or especially their prices, which, even if I put some of that personal taste or bias aside, I still feel that investing in any kind of retail company that isn't named Amazon is just not all that worth it to me these days. Because Amazon gives me all of the exposure that I feel I'll ever really need here in this space as a giant discount retailer that offers insane convenience and is even much more diversified into many other markets too, like tech, cloud, pharmacy, gaming, artificial intelligence, video and music streaming, electric vehicles, and just so much more. I mean, it really feels like they enter a new market every year. And so with all of that ambition, you're able to also get a ton of growth here, even at their already gigantic size, doing over $500 billion in sales and still managing to grow at a double-digit rate. Whereas other less diversified retailers like RH are much more heavily exposed to macroeconomic conditions, which is why you not only saw their sales dip about 5% last year, but they are still expected to fall another 15% this year as well. And even after losing over half its value from the top, RH stock is still trading significantly more expensive than the sector on a PE ratio basis, which tells me that it was probably way too overvalued to begin with. And while I can certainly understand the temptation to buy a stock like this on such a huge drop, I just don't really see enough growth potential or any kind of excitement really for their business to warrant buying into it as a long-term investment. Maybe if it was at least paying like an attractive dividend, maybe then I'd be more interested, but they don't even offer that either. So I'm going to rank it here at last place. I'm going to put it at number 5 because I just have no real interest in this stock myself. Moving on to purchase number 3, though, we have another stock that I don't think I've ever covered before on the channel, but that is Thermo Fisher Scientific, ticker symbol TMO, which Cohen increased his position on by a gigantic 193,000%, bringing it up to almost $225 million worth. Now, granted, it was a pretty small position relative to the rest of the portfolio to begin with, but that's still a very large purchase here that kind of came out of nowhere. Now, if you've never heard of this one, well, as the name implies, Thermo Fisher Scientific is of course a science-based company, primarily in the life sciences field, where they provide all sorts of analytic, diagnostic, and other laboratory and biopharma related products and services. For example, they help with research, discovery, and even production of many different drugs, treatments, and even V-shots, while also conducting all sorts of processing and diagnosis of various infections and diseases. It's of course a pretty high in demand field these days, and considering how large Thermo has already become with strong financials on both the top and bottom line to the tune of billions of dollars, which were also boosted during the pandemic, and how they're now serving hundreds of thousands of different customers worldwide, well, it's pretty unlikely that they'll ever go out of business or stop being relevant, especially now that these giant corporations know just how much money can be made from infectious diseases given what happened during the last pandemic. But speaking of that, coming off of the pandemic, the flowing river of government spending and large cash flows pouring into these biopharma related companies has certainly dwindled down a bit, with Thermo being no exception, as they experienced a small dip last year and are now expected to fall about flat this year as well, before returning to a high single-digit growth rate in sales the year after. I'm sure they'll be fine longer term though, and this recent dip wasn't nearly enough to knock the stock price off of its upward trajectory, having now more than doubled in the past 5 years and more than quadrupled in the past decade, while still trading fairly close to an all-time high. And even with the valuation being a little higher than the sector, I actually think it's not all that crazy or overly expensive. So considering the otherwise pretty strong business, I think the stock is fairly solid for most long-term minded investors. But the only reason why I'm going to rank it a little lower here is because their dividend is extremely small at just 0.25%, whereas many other biotechs pay much more attractive dividends, like Pfizer, for example, who yields over 6%, or even Evergy, who is on today's list and not only has a much bigger dividend of over 5%, but it also carries a cheaper valuation too. Obviously, they're not a biotech or anything like that, but I'm comparing it in terms of the dividend and the valuation. So because of that, I'm going to rank Thermo at number 4 here, and I'm going to keep Evergy higher than that at number 3. Okay, that will, however, bring us now, though, to the final 2 purchases of the list, which are also the largest of the portfolio relative to the rest of these. And so coming in here at purchase number 4, it's going to be none other than Oracle, ticker symbol ORCL, which was a brand new addition for Cohen, where he purchased nearly $230 million worth just in the fourth quarter alone. Now, as you could probably tell, I haven't been a huge fan of Cohen's purchases so far, but I gotta say, Oracle does get much more of my attention here, as after being founded back in 1977, Oracle has really come a long way from just being a database management software, which it still commands a lot of market leadership there, by the way. But these days, it's also been building up a very strong presence in some of the other largest and fastest growing tech markets in the world, like cloud computing and artificial intelligence, with currently 66 data centers operating around the world through their Oracle Cloud Infrastructure called OCI, and another 100 more data centers are being built as we speak, which will be using their Gen 2 cloud technologies that have AI automation at their core and will be used for all sorts of AI training and processing. And this, of course, is due to the skyrocketing demand for AI infrastructure that has really ballooned in recent years, where the company's chief technology officer, Larry Ellison, who's of course also famous for being the founder of Oracle, he recently said that they also have billions of dollars more in contracted demand than they can even currently supply, adding that their collaborative work with NVIDIA, of all companies, using their GPU cluster technology is some of the most advanced work in the world, offering developers the ability to train AI models at twice the speed and half the cost of their competitors, which is pretty impressive. And of course, we all know just how popular and in high demand these generative AI infrastructures have really become recently, especially for NVIDIA, who just saw a record-breaking $277 billion of added market value in a single day of trading after reporting earnings, which was the largest single-day increase in stock market history, bringing their market cap up to now about $2 trillion, which is more than double the size that it was a year ago. I mean, it's just absolutely incredible. And so if Oracle is able to improve their efficiencies even further, then that could be a major growth driver for them as well. Speaking of which, Oracle has already been posting some fairly impressive growth rates of their own in recent years, with revenues rising by close to 20% last year. However, that does seem to be correcting back down a bit this year before returning to growth again the year after. I wouldn't be too worried about that dip myself, though, as there really does seem to be plenty of future potential here and demand for a tech stock of this caliber, which even after doubling in the past 5 years, the valuation is actually a lot cheaper than you would expect, at about a 30% discount to the sector on a PEG ratio basis. So it might have been undervalued just kind of to begin with. Plus, they also pay a small but very high growth dividend too, which sure, it's not as attractive as Evergy's, but I think the more exciting business here does make up for that. So I'm still giving Oracle the slight edge here at number 2, and I might even consider buying some of the stock myself if it ever starts dipping again. I just, I feel like maybe it's a little too high, but I do really like this stock. With that said, guys, we are now left with the 5th and final purchase, which is also the largest position of the list. And that's actually going to be an ETF, if you can believe it here. It's a SPY S&P 500 ETF. The ticker symbol is SPY, which Cohen increased his position on by over 5,500% last quarter, bringing it up to nearly $270 million worth. I will say, though, that this is mostly just like a broad-based market ETF that tracks the S&P 500. So it's very similar to just buying some of the largest American companies in a single basket for more of a hands-off approach to investing, which I think is totally fine for anyone that, wants a trusted ETF with the most liquidity. It's actually the most traded ETF in the world and is provided by State Street, which is one of the largest asset management companies out there too. And I'm sure you'd get decent enough returns from it too, with SPY currently up over 80% in the past 5 years, up over 170% in the past 10 years, and they even pay a small dividend too of about 1.3%. But for me personally, I just prefer choosing my stocks individually one by one, trying to find the best growth opportunity or value or even dividend, which I feel that both Oracle and Evergy offer much more of that in each of those categories. So I'll put SPY right behind them at number 3, and I'll push the other two up one spot to fit it in. But there you have it, guys. Really, for being such large purchases here in the portfolio, I would say that these actually weren't the most exciting stocks out there. I mean, I do kind of like Oracle and Evergy, so I will give Cohen some credit for those. They're picking up a value dividend stock in Evergy, and kind of like smaller, I would say Nvidia-like alternative in Oracle at a cheaper valuation, cheaper price. It's kind of thinking outside the box there, kind of like that one too. But overall, there's just not much else here that I would even feel tempted to really ever be picking up and adding to my portfolio. So the entire package just feels a little underwhelming for me. Not too crazy of a quarter here when it's all said and done. Were large purchases, large increases, but the stocks themselves, a little underwhelming. That's just my opinion. That's my assessment. I'd love to hear what you all have to say down below. Do you own any of these stocks? Do you agree with my ranking on them? Let me know down there. But anyway, I hope that you enjoyed the video regardless. And thank you so much for stopping by, my friends. I really appreciate all of your support. And I will catch you in the next one. I hope you're all doing well. And I'll see you next time. Take care, everybody. Bye-bye.